Walmart and Amazon are two of the largest companies in the world if you measure by revenue and total employees. But which one is the better investment? Which one is the better stock to buy for 2025? That's the question I'm going to answer in this video. Comparing these two giants across revenue, profit margins, cash flow, return on invested capital, and then finally looking at their valuations on a forward price to earnings basis. And I'm going to share with you my discounted cash flow valuations for both Amazon and Walmart and bring it all together to come to a conclusion on which one I think is the better buy heading into 2025. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. I highlighted that these two are two of the largest companies in the world when measured by revenue and total employees. Well, Walmart still has a roughly $50 billion advantage against Amazon. Walmart generated a whopping $673 billion in trailing 12-month revenue, while Amazon generated a astonishing $620 billion in trailing 12-month revenue. Both incredible figures, and figures that really demonstrate the power, the negotiating power that comes with controlling this much revenue. This much revenue means, and one way Walmart has used this power is against its suppliers. Walmart has been notorious for keeping suppliers in their respective categories, delivering the products that Walmart wants at low prices and at continuing low prices. And so Walmart negotiates aggressively with their suppliers, making sure that they're meeting these milestones on lowering price, on delivering these items on a timely basis. It's difficult to be a supplier of Walmart. They have high standards. Now you might say, well, the quality of their products is not great. What do you mean they have high standards? And I would agree with you that the quality of the products that Walmart sells is not good quality products. But what I mean by they have high standards is in business execution. If Walmart tells a supplier, hey, we need 100 units of this product at this price, at this time, at this location, you've got to be able to meet those terms. You can't miss on any of those terms. You can't miss on the time of delivery. You can't miss on the location. You can't miss on the price. You've got to hit that target on all fronts. Otherwise, Walmart will exclude you from their supplier list because you're unreliable. You can't meet those standards. And if you don't meet those standards, then Walmart is going to have empty shelves. Walmart is not going to have products at low prices that its customers are looking for. So in order for Walmart to maintain that low cost advantage, that low cost strategy, it utilizes its relationships and its strong negotiating power against its suppliers to sustain that competitive advantage. Walmart's relationships with its suppliers is one of its main competitive advantages. Very few companies can boast that kind of relationship with their suppliers. And so that's one of the benefits of scale, one of the benefits of being such a big company. Meanwhile, Amazon has different kinds of competitive advantages. Some are similar to Walmart. Of course, Amazon does also exercise negotiating power against its suppliers, and suppliers have to meet standards as well in terms of delivering products at the prices and making sure that they're not selling the same product on a different site at a lower price than they're selling on Amazon.com, so that buyers, when they're looking for a product, they go to Amazon and not another website looking for that product. But Amazon's competitive advantages rise more so on its logistics network, its fulfillment network, its ability to deliver items to customers quickly and at low cost. And that's risen as a result of its scale as well. The size of Amazon's e-commerce business allows it to serve each customer more effectively, because if Amazon is already making a delivery down the street and then another customer from the same street makes an order for the same day, then that's significantly lower cost for Amazon to serve because they're already sending a driver on that street, and it's only one other stop on that same street. And so they're both benefiting from this scale, and the economies in scale has allowed these companies to continue growing while still generating strong profits. Speaking of profits, let's start with cash flow from operations. And you notice Amazon delivering much better cash flow from operations than Walmart, more than 3 times this level. And Amazon continues improving its cash flow from operations to sales on a trailing 12-month basis. And this should tell you as an investor is that Amazon's business has more foundational economies of scale built in. The business benefits more so from its economies and scale than Walmart does from its economies and scale. As Amazon has grown larger, its cash flow from operations has expanded higher, while Walmart hasn't really expanded that cash flow from operations to sales figure. And you could see a similar trend here with the operating profit margins. Amazon, as it's grown larger, has expanded its operating profitability, its operating margins, while Walmart hasn't really done so. In fact, Walmart's operating margins have decreased since 2015 up until today. Part of that will reverse, I believe, for Walmart. Part of the reason why Walmart's cash flow and operating margin have been declining over the last decade is because it made a big strategic shift. It resisted the online business. It resisted the full leaning in of the online business up until about mid 2015, I would say. That's when 2015, 2016, 2017 is when Walmart started aggressively pushing its online business and building out the network, the logistics, and everything that's required to have a booming online business. And so those initial investments over these last 6, 7, 8 years have brought down the margins initially, but longer term, I believe they will expand Walmart's margins going forward. Initially, they've cannibalized some of its existing business. When people walk into a Walmart, that's a more profitable customer than when someone buys something from Walmart's website. Still, longer term, as more people buy from Walmart's website and Walmart is making these deliveries more frequently, it'll benefit from similar economies of scale as Amazon has in the logistics network. Although it will be difficult for Walmart to achieve the same kind of improvements that Amazon has achieved because Amazon's achievements have been remarkable. They have been an outlier. And so it's not common to see this kind of improvement at this scale. So it wouldn't be something that you just say, oh yeah, Amazon and Walmart's going to do the same thing. Maybe they will, maybe they won't. All right, now that we've looked at the characteristics of the business, let's look at valuation. And when measuring by a forward price to earnings, Amazon is only slightly more expensive than Walmart, trading at a forward PE of 36 compared to 34. If this was the only metric we were looking at in terms of valuation, it would make Amazon a no-brainer for me because you saw the better, cash flow and the better margins and the better economies in scale Amazon has delivered over Walmart, and that's likely to persist. And so at just a small premium, it would be a no-brainer. But what about if we look at the discounted cash flow valuations? Well, in this case, my intrinsic value per share for Walmart is $117. The market price is $93. So it is undervalued by roughly 20% according to the discounted cash flow valuation model. What about Amazon? Well, my intrinsic value per share for Amazon is $286 and the current market price is $224. So an undervaluation of roughly $60, about one fourth here, 25%, roughly 25% undervaluation. So similar undervaluation here for Amazon and Walmart. So all things being considered, if I was to pick between these two excellent businesses, I would pick Amazon as the better buy for 2025 and beyond. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.